bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the December 10th, 2024 podcast. As our audience watching on YouTube can see, my guest this week is Christina Apostolidis, a partner in Novogradac's Naples, Florida office. We're down to the final weeks of 2024. This means for many professionals working in affordable housing, especially developers and managers who placed properties in service this year, it's a time to reassess how their actual performance is comparing to what they originally projected. More specifically, how their current projected delivery of tax credits to their investor compares to what they originally projected when they negotiated pricing terms with those investors. Christina is here with me today to discuss the importance of revisiting financial forecasts to assess that as we approach year-end. As you probably guessed, this is the latest installment in our So You Want to Be a LIHTC Developer series. This series is designed to help developers, investors, syndicators, and others learn the basics financing affordable rental housing with tax credits. Now, for our listeners' convenience, as well as for our viewers on YouTube, we do post a playlist of episodes in this series. The playlist is available on our YouTube channel. I'll post a link to the playlist through my account on X, formerly Twitter. My account is @Novogradac. I'll also include a link to that playlist in today's show notes, and I'll also send it out on LinkedIn. You can also go directly to our YouTube channel. It's youtube.com/NovogradacCPAs. And while this series is aimed at covering local tax credit basics, it's also designed to be useful for more experienced developers. In part, it's a concise refresher for those already working in affordable housing, as well as providing a handful of tips that an experienced developer may not be aware of, or at least may not remember. Now, in preparing for this podcast, Christina and I identified 3 key areas to revisit as a developer manager as you're nearing the end of the first year that a property is placed in service. All 3 of these areas that we're going to discuss today affect the amount of credits that a property will qualify for. Now, first, we're going to discuss why you should, before year end, compare your actual versus your forecasted building placement and service dates. Second, we'll similarly discuss why you should review the lease-up status of each building. And third, we're going to discuss why it's important to update your expected eligible basis. Now, I'd like to note for our listeners, this is not, nor is it intended to be, an exhaustive list of items to be reviewing as you approach year end. Rather, these 3 areas that we're discussing today are illustrative of the value of updating all your assumptions in your financial forecast before year end. Now, as I say here often on Tax Credit Tuesday, forecasts never match what actually happens. Forecasts are intended to be close approximations, as actual events never occur exactly as projected. And that's why it's important to update your forecast now to see where those differences are. In part, this is something that we find lots of developers are usually pretty sensitive to. When they originally negotiate their agreements with their tax credit investors, since they are based on projections, the investor includes upward and downward adjusters, or I should say, always have downward adjusters and oftentimes have upward adjusters to some extent as well. Now, as you're thinking about this episode, I do want you to know that it's not just for properties placed in service this year in 2024. It's also for those who are listening that are planning to place properties in service in 2025, 2026, or later. The key with this podcast episode is it's about considerations in the year buildings are placed in service, irrespective of the year. Now, Christina is very familiar with this year-long cycle and is, as such, a great guest for today's show. She's one of Novogradac's leading experts in local tax credits, and she's here today to give her overview and her thoughts on these 3 areas. Let me also note, Christina is the chair of the upcoming Novogradac 2025 Affordable Housing Developers Conference. That will take place early next year, January 16th and 17th in Fort Lauderdale, Florida. This conference in January is a great opportunity to start the year by meeting with others, network with others involved with the long-term tax credit, and to hear about how they're navigating various financial hurdles that inevitably arise. That's also an opportunity to delve deeper into the tax credit equity market, tax and bond financing, value of market studies, the benefits of including green energy and affordable housing development, and much, much more. For more information on that conference and other upcoming Novogradac conferences, visit our website at novoco.com. That's NOBOCO.com. Or you can simply Google Novogradac 2025 Florida Conference. We hope to see you there. And in the meantime, Christina and I have a lot to discuss in this week's episode. So if you're ready, let's get started. Christina, welcome back to Tax Credit Tuesday.
Thanks, Mike. Thanks for having me again. I enjoy doing these with you and kind of reaching out to our clients and potential clients out there.
Grace, certainly a pleasure to have you back. And we're almost bookending this year by having you as a guest. You were our first guest of 2024 back in January, and now you're back as our penultimate guest for 2024. But before we dive into this week's conversation, please share with our audience some of the services that you provide to clients here at Novogradac.
Sure. My specialty here at Novogradac is LIHTC. So I do work with a lot of developers, different states, can work anywhere from initial application, some forecast services, kind of helping developers put their financial models together, and then taking it through development, doing cost certifications, 10% tests, 50% tests, all the way through place in service and annual audits and tax returns. But it's one thing I really enjoy about Novogradac and our firm, and I feel like it differentiates us from a lot of maybe our competitors out there. That at Novogradac, a lot of our partners, we deal with everything from, compliance and audit and tax. And, we really get to know our clients and their projects and really, get invested in what's going on with their business. And then I also work on the syndicator side as well. So kind of see from the investor's perspective how important and, what's important to them when they're looking at projects throughout the project's life cycle.
Right. Thank you for that, Christina. And let's now just jump into today's topic, which is the importance of updating financial forecasts before year end. And as I noted in the introduction, that we're going to discuss three key assumption areas that you and I identified as part of preparing for the podcast. And and when I think about the sort of three areas, I think about the place and service date. That affects when or sets the point in time when you're even eligible to begin claiming credits. There's the lease-up, which affects when you can start actually claiming credits, given our property's been placed in service and now you're starting to get occupancy. And then, of course, eligible basis, which you have to look at what percentage of the property is rented to low-income families for what portion of the year, times your eligible basis will determine your actual qualified basis, which is the foundation of determining your tax credits based on your credit percentage. So let's start with the placement and service dates. And I want you to share with our audience several reasons why it's beneficial to be looking at those place and service dates now before year end.
Yes. So the first thing I would suggest looking at is place and service date and what actually happened. So what if the place and service date occurs earlier than expected, right? So what does that mean? And potentially that could be a good thing, right? Because if once a building is placed in service, its units are eligible to begin counting towards the first year applicable fraction. So right now we're in December. So if you wanted December to count for your applicable fraction, that building should have been placed in service by December 1st, pending that you get your building qualified leased up by December 31st, right? So December 1st was the date to meet.
So just to sort of emphasize that here, just to put an extra asterisk or an exclamation point, not an asterisk. It's more than an asterisk. It's worthy of multiple exclamation points. the building has to be in service for the entire month. So generally speaking, it's important to have the building, placed in service on the first of any given month. If it's placed in service in the middle of the month, there's no credits for that month. But you actually determine the long-term occupancy based upon tenants being in the unit by the end of the month. Did I summarize that well?
Yep, that's
Okay,
perfect.
great.
So yeah, so if you place in service, early, again, that might mean you can deliver more credits than expected, which could lead to an upward adjuster if that's what was in your partnership agreement with your investors. So again, just knowing your place in service date and what's actually happened. An earlier place in service date can also lead to an increase in other tax benefits, such as the amount of depreciation that's taken. Depreciation and tax losses are also important to investors, so you want to know that. And also the timing of other credits. So if your project has layered in energy credits, historic tax credits, those are all credits that are timed with placed in service. So you want to make sure that you're aware of those. Just kind of a side note, bonus depreciation also is a big thing that our investors are looking for. And bonus depreciation is scaling down. So in 2024, the bonus depreciation amount is 60%. And in 2025, it's 40%. So again, all kind of factors that you want to make sure you're aware of, that you can have these discussions to your benefit. But just a caveat there, placing in service early, like I said, is a good thing normally, but you want to make sure you check with your investors, make sure that they're aware of, this happened, start having those discussions with them. You want to make sure that the timing still works for them. At the project level, it's one scenario, but then also you want to be aware of what the investors are looking for. Can they use those earlier credits, right? So again, real important there to make sure you're having those discussions.
I think you could also touch upon the fact that place in service date is building by building. Most clients probably, and most listeners probably know that, are others in our audience. And if you could also talk a bit about act rehab and how place in service dates for purpose of an acquisition rehab and determining your tax credits are unique.
Right. So the place in service date, like you mentioned, is a building by building. So what happens if your place in service date is later than expected, right? What are some of the things that you should be doing now to maybe mitigate some of those downward adjuster scenarios that might be occurring? So because the credits are taken building by building, you want to start looking at, okay, what actually happened per each of your buildings, because it's possible you don't have to wait till the whole project is placed in service. Remember that. I think sometimes with layering of all these rules, it's easy to confuse them, but just a reminder, if you have one building fully occupied and leased out, that building can start taking credit. So you want to make sure that you're still paying attention to each building status.
And then for act rehab.
Yes, for AC Rehab, thanks for the reminder. For AC Rehab, the important part with the acquisition rehab is that your place in service date is a little different, right, than your new construction. So for your AC Rehab projects, your place in service date is actually the date when that project meets its substantial rehabilitation. So what does that mean? So that means that the project has spent at least, right now, the amount is $8,300 per unit, or 20% of the adjusted basis. So right now, this month, if you're an AC Rehab project, you want to make sure and take a look, has the project met the substantial rehab test? And I think this is one thing that often also gets, kind of, you lose sight of it. Because you think that, maybe we're still under construction, we're still doing our rehab, but definitely taking a look at this test now will let you know if your project has met the test. And the benefit of meeting the substantial rehab means that now if you met the substantial rehab test, that's the year that you can start taking your credit.
It's just interesting that, we got a favorable ruling from the IRS years ago, where when you looked at the renovation, technically under Section 42, as you know, the acquisition building the acquisition itself is an existing building. It has its place in service date. And the renovation is treated as a separate building for tax purposes. So you end up basically having two buildings instead of one. So it's always interesting because if you have a 10 unit or a 10 building property, you end up with 20 Form 8609s because you have a separate 8609 for the rehab and a separate one for the acquisition credit. And, Christina and I and others at Novogradac have lots of clients that are doing in-service rehabs and such. So the question was, when do you start claiming credits on the renovation? If it's an in-service rehab where you have the acquisition one, clearly you could start claiming credits when you're leased up on the acquisition, and an in-service rehab, you can be leased up pretty fast, but your rehab could be placed in service much later in the year. And the good news from a tax credit value perspective is that rehab does tack back to the underlying place in service date of the acquired building. So your place in service date for the rehab isn't really relevant to claiming credits. It's more just making sure you meet that minimum threshold. And most state agencies have a much higher minimum threshold than the 8,300. So it's really a question of, is the 20% more or less than the state minimum? And that'll be a large function what your acquisition price is. But anything else you wanted to say about place and service date before we move on to lease-up status?
Just the other thing I just wanted to mention was, as you're looking, if you run into the situation where you're in a downward adjuster situation because you didn't meet the originally expected place in service date, just some other considerations that the project might consider. Maybe you didn't originally plan on layering energy credits. And so if you're in a situation where you're deferring credits to the next year, at least the start of your credit period, you're delaying it, you may consider, okay, I have some more time now to add some basis that might mitigate the effect of a downward adjuster. Another thing, we discussed too was if you haven't already done a cost seg study. So cost seg studies are a good tool for developers to use and have when they're negotiating with their investors. A cost seg study allows an entity to allocate its basis to its various personal property categories, which then accelerates and give you more depreciation up front. Also allows you to take benefit of the bonus depreciation as well by moving basis into some shorter life categories. So if you haven't already done one, this might be an opportunity to engage a cost seg study to be performed. Again, that's something to just mitigate some of those effects of the downward adjuster.
Yeah, I like the fact that you mentioned communication with the investor and a lot of these strategies as you're kind of approaching your end. It's important to be chatting with your investor to assess their view on these various items. And I'm glad that you mentioned the importance of getting a cost seg study, a cost segregation study. Our partner, Craig Staswick in our Long Beach office leads up Novogradac's cost segregation study practice. And for those who aren't that familiar, we do have another podcast on that. So please go back and check that podcast. It's pretty much an evergreen podcast, but the overall concept is you do a more detailed look at all your various project costs. When you do a more detailed look, inevitably more of those costs end up allocated to personal property and land improvements. And that accelerates the depreciation for tax purposes. I would note that for book purposes, it doesn't affect the losses because the cost segregation study, the book costs aren't as for book depreciation methods and the rest of no expensing and things like that. So it's not really adverse from a book income perspective, but it's definitely beneficial from a tax perspective. And then you're mentioning potentially layering in energy credits and checking with your investor on the rest. That's a good tip as well. So let's move on to the second of the three areas. and that's assessing the lease-up status of the property. And really, it's not so much the lease-up status of the property as much as individually looking at the lease-up status of each individual building, because as Christina noted earlier, your credits are determined on a building by building basis. So Christina, if you could share, or please, I know you can, please share the importance of the lease up of a LIHTC property in that sort of first year and some of the lease up strategies to maximize credits in the first year a LIHTC property is placed in service.
Yeah. So like we discussed, so, being placed in service makes the property eligible to start credits, but having qualified tenants by the end of the month and for sure by the end of the year will determine how many credits you can take. So that's why now is a good time to make sure you're reviewing your lease-up reports, making sure your tenant files are in good shape and reviewed so that you're confident in your first, that you've met your minimum set aside at the end of the year and also have enough support to substantiate your first year credit calculation. By reviewing the lease-up data, the property owners and managers are going to be able to, assess and consider whether or not they can actually start the credit period. We talked about the possibility of needing to defer. If you don't meet your qualified target applicable fraction by December 31st for a particular building, that will cause 15-year credits. So when we talk about 15-year credits, we're talking about the fact that instead of being able to take the credits over 10 years, the project will have to take those credits over 15 years, or the basis on those credits over 15. And that's not a good situation to be in. The project and property managers will be in a position to assess, okay, can we start our credit period, or is it more beneficial to defer? And generally, in most cases, it's more beneficial to defer the start of your credit period. 15-year credits aren't really valued that well by investors. Usually they're looking at that 10-year credit stream. So again, important opportunity there.
Let me just kind of emphasize there, because oftentimes I know you and I and others at Novogradac, you end up working with the developers on this 10 versus 15-year credit question. It's applied on a building by building basis. You have to look at a given building and see how leased up is it by the end of the year and assess if I can claim some credits in the year that I place the building in service. And then, if I'm not sort of sufficiently leased to get my full credits, and there's going to be some portion of those 10-year credits that become 15-year credits, and you have to weigh the benefit of claiming credits in the current year versus some portion being 15-year credits and how that affects your tax credit adjusters. Because the flip side of this 10 versus 15-year question is you could say, well, I'm not going to claim credits in the year I'm placing my building in service. I'm going to claim them in the next year. And that gives you the full year to get sufficiently leased to have no 15-year credits, but you also forego those credits in the first year. And as you were noting, generally speaking, the 15-year credits is sufficiently deleterious to the value to the investors that you're generally going to be pushing that out. But there's definitely been circumstances that we've seen where the 15-year credit amount was going to be small enough that it was still beneficial to place the property to claim credits in that first year. And there's a lot sort of embedded in what I just said there. And I do encourage our audience to reach out to a Novogradac professional that you work with to unpack this a bit more as we approach the end of the year, because it is a very technical calculation that's applying the various rules of your optionality here, along with what the limited partnership agreement says in terms of your adjusters. But please add to that or further expand, Christina.
Right. Yeah. So this is like the opportunity. This is the time where, like Mike said, looking at your lease-up report, if things are different than what was expected, you definitely reach out. We enjoy kind of working through these issues with our clients just to make sure that we're maximizing the benefits. And, also just keeping in mind with multiple building projects, you want to make sure that you're prioritizing occupying full buildings versus the project as a whole, right? So like we said, as long as that building was placed in service for a full month and it meets its qualified occupancy by the end of the month, that building can count credits. So if you're a 2 or 3 building project, it doesn't, and you're coming close to year end, it doesn't make sense to lease up all the buildings in a kind of ladder kind of method. You want to make sure you target, buildings as a whole to meet that.
What are some of your thoughts if a developer is using the average income approach to meeting their set aside? Any additional considerations that you wanted to share?
Yes. So we're seeing a lot of our average income properties being placed in service now, just kind of how the average income came about. And then once the regs came out and made everything a little more clear. So now in 2024, I'm seeing a lot of average income properties being placed in service. So just kind of a few reminders and, making sure you differentiate the rules a little bit there. So with average income, 40% of the unit's imputed income must average to 60% or below, right? So we have this new kind of 40-60 set aside, but it's 40% of the units of the project's imputed income must average 60% or below. So it's possible you have some imputed income units that are 20%, some that are up to 80%, but the average of that group must average 60% or below. And so average income kind of layered in this new concept of a qualified group of units. And the qualified group of units has to meet its minimum set aside. So, and that's a project-based rule. So therefore, it's important how the buildings are grouped together. Remember, we have this multiple building election on the 8609s. And that election is very important when you're dealing with average income projects and how you group your buildings. So each building doesn't need to meet the minimum set aside as a building, but it needs to meet it how you designated and you grouped your projects, your buildings together to meet that multiple building. So for example, if you have a multiple building project that's using average income, it's possible to meet the average income set aside, but not all buildings are yet qualified leased up, right? So again, this even more so than a normal multiple building project, when you layer in average income, you really want to understand the status of each building and how that grouping then affects the project as a whole.
No, it's definitely more challenging because at least with if you're not using average income, what your max income level is to be eligible, and you're making sure every tenant's eligible basically on a standalone basis, such that the calculations on a single building project or a multiple building project are much simpler. And as you know, with the average income, you've got to have the average income be below the 60% very immediate income. And as a consequence, you have to be more focused on the individual tenants and how they affect the overall average. So the lease-up issues become notably sort of more complex, certainly manageable in the rest, and it's good public policy. There's for a host of reasons from leasing up and all the rest. There are a lot of benefits to using average income, but it does bring in this added layer of complexity, which may be the starting point of all of this, Christina. Probably should have been, make sure you're talking to your property manager and make sure both the property management firm more generally understands all these various rules, which I'm sure they do, or else they wouldn't be approved as the property manager, but also make sure as you're approaching the year end and leasing up that the on-site manager knows what your goals are. Because oftentimes as you kind of drift through that property management firm, the person that's there dealing with applications and the rest may not understand the level of this issue as well as you do. And while you might develop a strategy for leasing up the property and maximize your credits in the first year, a strategy is not very effective. It's not put into action. And it's the managers there, those that are working on leasing up units and the rest, where the rubber really hits the road. Anything that you want to say about Lease-Up before we move on to eligible basis?
Just kind of working with developers in the industry, just kind of some strategies that, we've discussed before about increasing occupancy. Again, like we said, you want to get tenants in there by the end of the month, or good property managers and developers and property owners are effectively marketing lease up prior to, pre-leasing units, right? Prior to placing service. So don't wait to place in service to start, getting those units
Yeah.
leased out. When it comes to December, just some rent incentives helps, or or any end of the month as well. So just keeping that in mind, is a strategy that many people use, whether it's reduced rent or other move-in specials to get people in their units, and then definitely just tracking the progress and using a strong property management company and keeping good records, and using tenant file reviews as well. Making sure that you're implementing all those just to, managing your lease out.
So thank you for that. Now let's move into the third item. We've talked about the ability to place in service, and we talked about lockbox percentage that ends up determining, what portion of your eligible basis can qualify for tax credits for what portion of the year. But we do now should talk about the eligible basis. And in the original, forecast, a developer will be projecting out what the eligible basis is projected to be. And as I mentioned multiple times in this podcast, that's just a projection. Actual will be different. Not the least of which is your updated eligible basis had a contingency. And the contingency now either was or wasn't used. And, the contingency in and of itself isn't a cost. It's a contingency for costs. So you didn't have to look at what the actual costs are. So we know this is one of those areas where it's not theoretically possible to even hit that because you're going to use the contingency and you need to look at that. But more broadly, please share with the audience here, some of the benefits of updating your eligible basis before year end. And maybe more importantly, what are some of the issues that you see arising when a developer goes from their projected eligible basis to actual?
Yeah. So with eligible basis, you definitely want to take a look at where we are now, right? What actually happened? What were the actual expenditures? When you're working with a 4% project, just a reminder, all your eligible basis, counts towards your credit calculation, right? So any changes, whether up or down, can affect your total credits. So with a 4% projects, very important. But also with a 9% project, you want to know, again, where's your eligible basis? Did it come in higher or lower? Because in the first year credit calculation, to maximize your credits, you want to make sure that you're calculating your credits on your total eligible basis. So regulations mention and allow that the first year credit calc, is based on your total eligible basis. So you want to take full advantage of that. So knowing that amount definitely is going to kind of let you know where you stand, calculate any effects on any adjusters that the project may be facing, and just really having that up to date really helps. And definitely having those communications again with your investors. We can't stress that enough. Some other issues with eligible basis too. We talked about 4% projects. On tax exempt projects, you have to be careful about your basis. So remember that, we have podcasts on 50% tests. So definitely listen to those. But with tax exempt projects, the project has to meet the 50% test by the end of the first year of its credit period. And any increase in the adjusted basis of the project can potentially bring the 50% test calculation down. So if you're, and I think going over basis happens a lot now, construction costs, interest rates. So definitely something to be revisiting now before the end of the year, and talking again to your tax credit experts and, ways to kind of mitigate the effects of, not failing the 50% test. So having those discussions now is super important.
No, I appreciate you mentioning that because on the one hand, if you're having cost overruns on a 4% bond deal, at least you look at it and say, well, I'm going to get some more credits. I can help offset some of the cost of the overrun. And then you end up running the risk of the cost being overrun by so much that your bond proceeds aren't enough to meet the 50% test. So you have to make other adjustments. And ultimately, we often see it's the developer fee that ends up being the amount that has to be reduced in order to still meet the 50% test, which is obviously not a good outcome, but it's a better outcome than losing credits for over half your project. My other observation would be with respect to the 9% transactions, generally speaking, or not, I want to say generally speaking, oftentimes I'll say 9% transactions have cushion in the sense that the amount of credits allocated for the project to claim are less than the maximum eligible because of the financial feasibility test and the like. So oftentimes with a 9% transaction, if you have quote extra basis, it doesn't help you so much with respect to the amount of credits you can claim annually, but it can help with the first year lease up with that, using that extra eligible basis to increase your credits in that first year. And that's probably also an issue that developers make sure that they're incorporating correctly into their forecasts originally, so that when they're negotiating with their investor, they're showing a more accurate estimated delivery of the credits. Once again, a lot embedded in that. So please reach out to a Novogradac professional. And the other thing I wanted to mention, because you had mentioned, Christina, that you're eligible for credits on your cost per bond deal, even if it goes higher, that you're still eligible for higher credits. That is true as a general matter, but the state agency, the allocating agency, does have to determine that you're eligible for those from a financial need perspective. And it's super, super rare, but it has happened. I have seen in the past where the state agency said, yes, your costs are higher, but you don't need those higher credits, and we're not going to give you an 8609 to claim them. Once again, super rare, not so sure it's good public policy, but I have seen it happen. So please be mindful of that. Christina, I did want you to talk a bit about the 50% test and the importance of spending bond proceeds. If you can explain what I'm hinting at there for our audience. Then once again, we do have another podcast that we have done on the 50% test and issues around productivity bonds and the tax credits. But this is year end, and this is something that could be a footfall that could be pretty dramatic.
Yes. So this is why we're talking about it on this podcast. We're talking about year-end issues, and you still have time by the time you're listening to this podcast to make sure if you have a tax-exempt bond project. We talked about the 50% test, and the adjusted basis is one factor, but the other factor is the tax-exempt bond proceeds that are financing that basis. And those proceeds are not only required to be issued. So when you have your bonds, you draw on your bonds, you also have to spend those. So you want to make sure that you're talking to your project manager, your internal accounting team, and make sure that those bond proceeds have actually been spent on the project's basis. We've seen this happen, unfortunately. It's an easy thing to miss sometimes because, it comes to the end of the year. Maybe you're, drawing for that, final draw. Remember that there is retainage that, it's at the year end, and there's a few costs, that kind of struggle. So if you're planning on starting your tax credit period, by the end of that year, you want to make sure that you're also spending those bond proceeds. So that's super important. And if you don't, and it gets missed, again, the offset is, well, now, my 50% test, is lower than 50% test. So how do I fix it? It ends up being a lot of times a developer fee that gets affected, which results in your eligible basis also. So again, not good news, but you still have time to definitely check that on your projects.
And I'd also encourage the audience, if you're experienced with this calculation, just know that so many allocating agencies now are not giving as many bond awards to a given development because they want to spread their bonds across more projects. So rather than getting 55 or say 60% of your projects, you had lots of cushion. They might be going 55 or 52, lowering that. So there's less cushion than is in the past. And we don't have time to go through the impact of interest income on those bond proceeds and the rest, but do know that, that it's more involved than just looking at your original award in terms of determining the bond proceeds and what counts for purposes of the 50% test. And to emphasize what Christina said is, you have to not, the bonds themselves get issued, and then the money is at some point available to the developer, and the developer will draw down on those bond proceeds. But as Christina mentioned, we don't want to be looking at your balance sheet at the beginning of next year and see this large cash balance, which is your drawdown from the lender of those bond proceeds. We want to see those bond proceeds, that cash actually then be used to pay costs as of the end of the year. And we're talking about spend the bond proceeds. That's sort of what we're talking about, is not have a large cash balance from drawing down on the bond, but using that to pay for costs or pay down the construction loan and the rest. And also, just as a refresher, generally speaking, you've got to use the bond proceeds either during construction or no later than the end of the first year of the credit period. And that's why if you're claiming credits for 2024, then that will be the end of the first year of your credit period. We definitely can see developers at times having to push out the start of their credit period just because of these bond proceeds issues. But once again, that's not an optimal answer. Once again, a reason to be looking at this before year end. Anything else you wanted to add to that? Once again, a lot embedded in what I said.
Right. Yes, no, that was a great recap.
So thank you for that, Christina. I will include your contact information in this week's show notes. And I once again would remind our audience that in addition to reaching out to Christina, I do encourage you to attend the upcoming Novogradac 2025 Affordable Housing Developers Conference in Fort Lauderdale, Florida, January 16th and 17th. I mentioned earlier all the reasons to attend, but I just want to also emphasize with the election results, looking for a major tax bill next year, January 16th and 17th, we'll have more insights into what's possible and not possible with respect to the law for the tax credit in particular, and the overall investor market kind of more generally, and the impacts of the potential tax bill. So please do join us in Fort Lauderdale. And then I'd also want to encourage folks to give consideration to joining the Law Enforcement Tax Credit Working Group. Christina is active with that, along with our partner, Dirk Wallace, and others at Novogradac. And as part of the LIHTC Working Group, we have monthly calls. And if ever there's a time to be joining the group, now's the time, heading into next year, at a minimum, getting the updates as to the status of federal legislation and the tax bill in particular from Peter Lawrence every month is immensely valuable as you're working through various development issues and planning for the future and negotiating with equity investors and the like. Anything else you wanted to say, Christina, before I wrap it up and get your industry shout out?
Yeah, just hoping to see all our listeners at the January conference in Fort Lauderdale. Our conferences are great. There's something for everybody. We start off with workshops. So this year we're having a LIHTC basis workshop, and then also an ag rehab workshop with some financing kind of issues also layered into it. And the workshops kind of set the stage for the main conference too. It's kind of a good opportunity to kind of get into the nitty gritty. So when you're listening to the conference panelists discuss issues, we kind of have a little bit more of a background. So like I said, there's something for everybody at our conferences. So definitely looking forward to seeing everybody.
Great. Thank you, Christina. I would also like to remind the audience to subscribe to our podcast on whatever platform you prefer, or even if you want to subscribe when you don't prefer, please subscribe. Please also share the podcast with your colleagues you think might be interested in following us on Tax Credit Tuesday. And please do, if you have a moment, leave a review of the podcast. It does help others find the podcast. And we do have a full archive of episodes available on our website at novoco.com. Now let's turn to our off mic section. And we like to use this space to give a shout out to someone who's working in the various tax incentives where Novogradac focuses. It's an opportunity to highlight a professional that many people already know, but who deserve recognition for all the good work that they're doing. Christina, who would you like to shout out?
So my shout out is Sean Nesbitt. He is the CEO of the Florida Housing Coalition. The Florida Housing Coalition is a nonprofit statewide organization which brings together housing advocates and resources so that all Floridians have a quality, affordable home. So Ashton's been with the coalition for a few years. He's previously served in the roles of chief program officer and technical advisor, and he really stresses educating the Florida community and particularly local governments to, better make use of the affordable housing opportunities that are here in the state, particularly with recently the Live Local Act here in Florida was passed a couple of years ago. So there's a lot of education that the coalition is doing, again, to making sure that the Live Local Act is being used to the best of its ability. And also just last thing about them, they annually issue the Whole Matters report, which presents current data in the state, the current challenges and some solutions. So which I think is super important just because having that data really gives developers and investors the opportunity to advocate with those making decisions at the local and state level. So super important that the data is available.
Great. Thank you, Christina. And let me echo your shout out as well. Thank you, Sean, for all the great work that you're doing. And more importantly, for all the great work you'll be doing over the next year plus. And then let me also tell our audience, let you know that we'll be back next Tuesday. Next Tuesday will be our final episode of 2024. And then we will take a short break for the holidays. Until then, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.